In Chapter 8, we're looking at inventories. So in your reading and through the lecture material, you can see that we're looking at the perpetual inventory system that says record all changes to inventory as they occur. The periodic system that says, well, record all purchases when they occur, record the sales revenue when it occurs, but wait till the end of the period or the end of the year, take a physical count of inventory, and we'll make one big journal entry to debit cost of goods sold and credit inventory. Just two different methods to recording the change in inventory. We'll be looking at the journal entries on both sides. Then we're going to be looking at exercise 8.8, which is actually in your book on page 449. So if you don't have your book, you want to grab that for the information. And that's where we'll be looking at how to categorize costs related to inventory. Then we'll look at how to remove inventory when we sell it under the periodic system and the perpetual system. And that's where we'll be looking at first in, first out, last in, first out, and average cost. And then finally, something brand new that you've never seen before called dollar value LIFO. And we'll explain what it is and why we have it. So let's get started. Exercise 8.1. Jerome Specialty Store uses perpetual inventory system. So that means they remove inventory, or I should say, they make a journal entry whenever inventory changes. The following are some inventory transactions for the month of May of year 1. Now, depending on the system we use, we'll have different accounts to record the purchases and freight costs, things like that. So let's take a look. Under the perpetual system, Jerome purchased merchandise on account for $5,600. Freight charges of $400 were paid in cash. Well, on May 1st, they'll debit inventory for $5,600, credit accounts payable for $5,600 because they were on account. They will also debit inventory for the freight charges they have to pay and credit cash. Now, in your reading, they talk a little bit about freight charges, stating that if the items are being shipped to you, the merchandiser, FOB shipping point, you will be paying for and are responsible for the freight associated with purchasing your inventory. The way the FASB looks at it is, this is a cost of inventory and should be debited to the inventory account. So whenever you have to pay for the cost to ship the inventory to you, you should debit the inventory account for those amounts. In item 2, Jerome then returned some of the merchandise they purchased in item 1. The cost of the merchandise they returned was $700. So they will debit accounts payable because that's where they originally credited. They did not pay for this yet. So since they didn't pay for it, they're going to debit accounts payable and credit inventory. Reduce the inventory account. They're sending it back. The next item deals with selling. So merchandise costing $2,500 was sold for $5,400 in cash. So remember, there's two journal entries that results here under a perpetual inventory system. We debit cash for the $5,400, credit sales revenue $5,400. But because we're always making a journal entry whenever inventory changes, we will also on that same day debit our expense account cost of goods sold for the cost of the items we just sold. So we remove them out of the inventory account by crediting the inventory. So remember, when you buy inventory, it's an asset. You own it. But when you sell it, it now transforms itself into an expense of selling. So that's why we decrease the asset inventory account and increase the expense cost of goods sold. So these are some of the typical journal entries you would see in the perpetual inventory system. Let's take a look at our next exercise. Here, we're now going to look at the same types of transactions, but instead of being a perpetual inventory system, we're going to assume Jerome uses the periodic inventory system. So let's see how the transaction journal entries will differ. When we're using the periodic system, all purchases are actually debited to a purchases account. $5,600 and credit accounts payable. So instead of debiting an asset account called inventory, no, we debit a purchases account. We don't debit inventory under the periodic system for any shipping costs we pay. We actually debit an account called freight in, and then credit cash. When we return merchandise, we don't credit inventory. We credit a contra account to purchases called purchase returns. When we sell the goods for $5,400, we debit cash and credit sales revenue. We do no journal entries when we sell inventory. And you have to think, kind of remember or think about this. If you're sitting there going, why are they doing this? Well, sometimes that was the only alternative. This system was very popular when I was in college 30 years ago. The Perpetual system wasn't. Why not? 30 years ago, when you went to a store, there wasn't scanning and buzzing and receipts with detailed information of everything you bought. There wasn't. What there was a white receipt with numbers on it, and that was the selling price of the goods. It kind of looked like a tape you would get from a desktop calculator if you just put numbers in. That was our sales receipts before 1990. Okay, so when we sold goods during those time periods, you knew what you charged the customer so you could record your sales revenue. You didn't know how much stuff cost. You didn't even know what you sold because there was no way of keeping track of that unless somebody stood at the end of the register writing it all down, and they didn't. Selling prices were manually entered into a computer or a cash register, and a receipt was generated with numbers on it that represented the selling price of the items. So the customers couldn't even see from their receipt what they bought. So how would the store know what they sold? They didn't. So this was the best system for them to track inventory. We'll see how they pulled it all together. I'm going to insert a slide here in a second so I could show you that. Because when they sold stuff, they just said, okay, we know how much we charged our customers. We have no clue what we just sold. Nobody wrote it down. So we couldn't remove the inventory versus that first exercise, because now we have scanning ability and tracking. And now the computer knows, hey, we just sold 10 coffee cups. We charged our customer $5,400. Those coffee cups cost us $2,500. So now we can remove the inventory as we sell it. The Perpetual system is a more predominant system because of technology. But we teach you both because there might be people out there who still use the periodic system. So let's take a look. How does a company remove inventory in a periodic system? So here are the steps. Whenever they're going to complete a financial statement, the company first determines the balances in the various accounts they use to record journal entries, such as purchases, purchase returns, freight in, and the beginning inventory balance. Next, they'll take a physical count of the inventory to see what is still on hand, and then they'll calculate the actual cost of the inventory sold. So let's take a look at an example. Assume the company starts the beginning of the period with $100,000. Purchases during the period were $200,000. So if you revert back to your journal entries, they would have debited purchases for $200,000. Purchase returns would have been credited for $20,000. So even if you draw little T accounts, your freight in is debited for $5,000. And then they did a physical count of the inventory, and there's $125,000 left of inventory. So first we'll show you how we calculate how much to debit cost of goods sold for. And we're going to do it for one amount. It's going to basically say here's all the cost of goods sold for the entire year, because we don't know what we sell as we sell it. We have to calculate it once at the end of the year. So inventory starts with a balance of 100,000 cost. We then added 200,000 in purchases and subtracted purchase returns of 20,000. We added the freight in of 5,000. So the total cost of all the inventory we could have sold totals $285,000. We add those four amounts, well, add the 3, subtract the 20. We then subtract from that. So here's how you look at it. Total cost of everything we could have sold is $285,000. So if we sold everything, we would be debiting cost of goods sold for $285,000. But we didn't sell everything. We have $125,000 of inventory left after a physical count. So when we subtract that from the total cost to sell, that will give us how much of the inventory cost we actually did sell, $160,000. Now let's take it one step further so you could see the journal entry to record that. You would first credit the inventory account for the beginning balance, and if that sounds weird, that's just the way we do it. You credit the purchases accounts so that when you post this, it will have a 0 balance at the end. So right now it has a debit of 200, credit it for 200,000. You're going to debit the purchase returns account, which currently has a credit balance of 20,000 for the entire balance, 20,000. Same with the freight in. It currently has a debit balance of 5,000, so credit it, so the balance will be 0. Debit the inventory account for the ending balance of inventory. We need the balance in inventory to be that much. And then debit cost of goods sold for the 160,000. So that's how we ultimately get the cost of all the inventory we sold into the cost of goods sold account and the proper amount of inventory into the inventory account at the end of the period under the periodic system. One journal entry. Where in the perpetual, we debit cost of goods sold and credit inventory after each sale. So that's the difference. Let's look at exercise 8.8 now. This is the one in your book. In exercise 8.8, we have the Phoenix Corporation's fiscal year is December 31st. They determine inventory quantity by a physical count on hand at the close of the business on December 31st. The company's controller has asked for your help in deciding if the following items should be included in the year-end inventory count. So now testing to see, do we know if something should be in inventory or not? Because sometimes things are accidentally put there or forgotten. So the first one, merchandise held on consignment for Trout Creek clothing. Well, it's excluded. When you hold merchandise on a consignment, all you're doing is selling someone else's inventory. You are not the owner of that inventory. So Trout Creek Clothing said, would you sell this stuff for us? Sure. We'll take a little bit of rent and we'll let you use our space and we'll sell that for you. So it is not included in Phoenix's inventory. Goods shipped FOB destination on December 28th that arrived at the customer's location on January 4th. The question is, should that inventory be included in Phoenix's inventory or excluded? Well, when goods are shipped FOB destination, the seller, Phoenix, owns them until they arrive on January 4th. So they own them at December 31st. They should include that amount in inventory. The third one, goods purchased from a vendor shipped FOB shipping point on December 26th that arrived on January 3rd. When goods are shipped FOB shipping point, the buyer owns them while they're being shipped. In this case, Phoenix is the buyer. I'm sorry. Goods shipped FOB. Oh, no, number 3. Goods purchased from a vendor. So we are the buyer and they're being shipped FOB shipping point. We own them on December 26th. So even though we didn't receive them by December 31st, they are included in our inventory at Phoenix. Number 4. Goods shipped FOB shipping point on December 28th that arrived at the customer's location on January 5th. Well, they're excluded. The buyer owns them when they're shipped. So they took ownership of them on December 28th. Phoenix no longer owns them. They should be excluded. 5. Phoenix had merchandise on consignment at Lisa's Markets Inc. Well, that should be included in their inventory. Now it's Phoenix who went to Lisa's Market and said, would you put our inventory in your store and try to sell it? Phoenix still owns it. Lisa's Market doesn't. Goods purchased from a vendor shipped FOB destination on January 27th that arrived on January 3rd. Excluded. The seller, the vendor, owns them while they're being shipped. Phoenix doesn't take ownership until January 3rd. And finally, freight charges on goods purchased in 3. Included. Okay, so if the inventory is being included, the freight charges are as well. So this is very important, especially even from an auditing standpoint. So you will see this even if you never work at a company with inventory, you may audit a company who has inventory. And we are very conscious of when does the company own that inventory. So this is a great exercise to look at. Exercise 813. Smithson Corporation uses a periodic inventory system. Remember, report purchases as they occur, but do not remove inventory till the end of the year or the end of the month, however they would like to remove it. The following information related to its merchandise inventory during the month of August, year 1, is available. So we can do first in, first out, last in, first out, and average cost, whether we're using a periodic system or a perpetual system. So the question comes about as to why do we even have these? Well, we're not to the point where each one of our items has a unique identification number on it. So if you have 3,000 rolls of toilet paper that you're trying to sell, each one has the same identification code on it. So when you sell one, it says, I sold toilet paper. Even in a perpetual system, I sold toilet paper and I charged my customer $3. But it doesn't tell you how much that roll of toilet paper cost. And that's why we still use it even in a perpetual. Periodic, we had to. So let's take a look and see how this works out. Determine the inventory balance of Smithson would report in its August 31st year 1 balance sheet and the cost of goods sold. It would report on its income statement using each of the following cost flow methods. Now remember, we are given a choice on how we would like to pretend our inventory was sold. Since we don't know exactly how it was sold, you're given a choice and you consistently apply it. You could pretend or assume first in, first out. The oldest inventory is always sold first. Last in, first out. The newest inventory is always sold first. Or average cost. It is not saying that is how it is actually sold. It's assuming that. And it's okay if it doesn't, if our assumption is very different than the way we actually sell stuff. That's okay. So let's take a look at FIFO. What we do first is we calculate all the goods we had available to sell. So we had 2,900 units that cost $7.18. We then added on August 8th 10,500 more that cost $5.71 each. We're going to ignore the August 14th for now and go to August 18th, our next purchase. We purchased 6,400 units for $5.67 each. So those are all the items we purchased during the month, or we started out with. So we had a total of 19,800 whatevers units that cost a total of $117,065. We know we sold 35 a total of 16,300. How do we know that? We sold 7,400 units. We charged the customer $12.07. So that's the sales revenue. And then we sold 8,900 units, charging the customer $10.01. What we have to figure out here is how much did those items cost? Under a periodic inventory system method, we say what were the newest items in our inventory. It doesn't matter when they were purchased. August 1st, 2,900 units. Then, and there we scratching those out. The first 2,900 units we sold of those 16,300 cost $7.18. The assumption is those were the first ones sold. The next 10,500 units that were sold cost $5.71. So far, we've accounted for 13,400 units. So the remaining 2,900 units we need to remove had to have cost $5.67 each. And that's how you remove them. But you look at the month, the purchases for the entire month, and then start removing them. It doesn't matter when the sale occurred. And that's how the periodic system works. It just says, here's all the stuff we had to sell. We sold a total of 16,300. How much did those cost? We remove them from oldest to newest. So what was left? 3,500 of the ones that cost $5.67 each, or a total of 19,845. Cost of goods sold for those units, 97,220. So that's how we come up with that dollar amount to put into the journal entry at the end of the year. So again, take a look. Here was my thing. We started with beginning inventory of $20,822. We purchased $96,243. You could see them highlighted. Everything we could have sold, $117,065 was the cost. The ending inventory was $19,845 under FIFO. So cost of goods sold, $97,220. So we use these methods to come up with the dollar amounts to go into that journal entry at the end of the year. FIFO is one of our choices. The next choice is LIFO. We're going to accumulate the information just like we did for FIFO. 2,900 units is where we started. They cost $718 each. Then we added 10,500 in our purchase on the 8th for $571. And then we added 6,400 more, $567 each. So we have our available for sale computed the same exact way. At the end of the month, we say we sold 16,300 units. How much did they cost? Well, under LIFO, or last in, first out, the newest items in inventory are removed first. They're assumed to have been sold first. So the 6,400 and then 9,900. 6,400 of the ones that cost $567 are removed first, and then the remaining 9,900 that were sold. Total 16,300. 6,400 are removed first, so then you have to remove 9,900 more. Come from the ones that cost $571 each. The remaining 600 units of the August 8th purchase would be an ending inventory, along with the 2,900 units that cost $718. So if you're sitting there going, wow, that really old stuff stays in inventory. Yep, it does. And if you're like me, I'd be like, wow, that stuff's getting dusty. No, it's not. It's probably sold, but we're pretending that's the way it's sold. So in LIFO, your cost of goods sold would end up being $92,817. Ending inventory, $24,248, because of the way you assume the items are sold. So under LIFO, beginning inventory, $20,822, purchases are the same, cost of goods available are the same, the prices don't change on them. But the ending inventory is much higher, $24,248. That's odd. Oh, that's okay, I see why. And the cost of goods sold is $92,817. Let's go to average cost. Periodic system. When we have the average cost method, we don't care what's old, what's new. We don't have to remove it from oldest to newest or newest to oldest. We just go, what's the average cost of everything we have? How much did it cost us per unit? So what we do is we take the beginning inventory plus all of our purchases, and we get total number of units we bought, total cost of everything. We then take the $117,065 total cost and divide it by the that shouldn't have a dollar sign there. That should be 19,800, no dollar sign, because that's the units. And you get $5.91 per unit. So now when you're computing cost of goods sold, you say we sold 16,300 units. Well, they cost an average of $5.91 each. So cost of goods sold is $96,372. When you're determining the final amount in ending inventory, the remaining 3,500 units, multiply it by $5.91, and that's your ending inventory. So under the average cost method, beginning is the same, purchases are the same, cost of goods available are the same. Ending inventory is different, 20,693, because you're removing it and leaving an average cost inventory, and then cost of goods sold would be the ending inventory would be subtracted from cost of goods available to get 96,372. So the only thing that is different because of the method you choose is how much your ending inventory will be in cost of goods sold. You have a choice, you pick one, and you consistently use it. This is how we complete these different costing methods for the periodic system. We account for all of our purchases with all of our beginning inventory, and then we say what are the total units we sold, and then we remove our inventory oldest to newest, newest to oldest, or by the average amount. In exercise 814, we're going to run through this same type of example, but this time the company's using a perpetual inventory system. They use first in, first out, last in, first out, and average cost. And we talked about why they still have to use a perpetual inventory system, because they don't know exactly how much an item costs that they just sold, but they could figure it out under one of these methods. Let's take a look. Usually we keep track of inventory on a perpetual inventory record because remember, we're going to remove inventory as we sell it. We don't wait till the end of the month like under the periodic system. So on August 14th, when we sell 8,000 units, 2,000, and we don't have it recorded in here, but you could record your August 1st, you have 2,000 units at $6.10. You just added 10,000 more at $5.50 each. So you have a total of 12,000 units at different costs though. The oldest are the 2,000. Those are removed first. So in that sale, when you're figuring out how much do I debit cost of goods sold and credit inventory for, the first 2,000 that you just sold for $12 each will be removed at $6.10 cost. The remaining 6,000 are removed at that $5.50 from the 8.8 purchase. So after that sale, you are left with 4,000 units from the 8.8 purchase that cost $5.50 each. On August 18th, you add 6,000 more units that cost $5 each. So when you sell 7,000 units for $11 each, that's what you charge the customer. But how much did those goods cost? Well, the first 4,000 are from that purchase left over on the 8th. 4,000 of them cost $5.50 each. The remaining 3,000 cost $5 each. So that would be your total cost of goods sold for that sale. Of the 7,000, oh, okay. Of the 6,000 you purchased on August 18th, 3,000 are left. So ending inventory would be 3,000 units that cost $5 each. So you remove it oldest to newest, but after each, as you sell it, that's when you remove it. You don't wait till the end of the month and remove it all at the same time. What if it's LIFO? Well, now we're keeping track of it. I like this method because you see it all in front of you. So we start the beginning of the month with 2,000 units at 610 each. We add 10,000 more at 550 each. So after this purchase, we have 2,000 that cost 610. They're still around, and then we just added 10,000 more that cost 550 each. Now, what happens when you sell 8,000 units? You charge the customer 12 bucks, that's your sales revenue. But under LIFO, how do you remove them? Well, you go to your last ending inventory balance and you go, oh, well, I had 2,000 that cost 610 and I have 10,000 that cost 550. Okay, I sold 8,000, last in, first out. The 8,000 I sold cost 550, and you remove them. That's how much you would debit cost of goods sold for. 44,000 in credit inventory for that sale. You're left with 2,000 that cost 610 each and 2,000 that cost 550 each. On the 18th, when you purchase 6,000 more, in your purchase column, you'll add that. And then you'll add that to your existing inventory balance. And yes, rewrite it so it doesn't get confused. So after purchasing 6,000 more, you still have the 2,000 that cost 610 each. You still have 2,000 that cost 550 each. And now you have 6,000 more, which is your newest amount, $5 each. So on the 25th, when you sell 7,000 units, you go to your last ending inventory balance and say, what was my newest inventory? The 6,000 that cost $5 each. They're considered sold. I'm removing them. And then 1,000 of the ones that cost $550 each. So cost of goods sold would be $35,500. What's left? 2,000 units that cost $610 each and 1,000 of the ones that cost $550 each. So your total cost of goods sold for both sales, the $44,000 and the $35,500, would be $79,500, and ending inventory is the $17,700. So this is a perpetual inventory record where you keep track of your purchases and the amounts you're removing out of inventory and putting into cost of goods sold for each sale. The average cost method. Now you will update your average cost per unit every time you have more purchases. So this is saying we're starting the beginning of the month off at 2,000 units. They have an average cost of $610 each. When you purchase 10,000 more at $550 each, you add it to your existing balances in inventory. You now have 67,200 in inventory, 12,200 plus 55,000 total cost. How many units? 2,000 units that were here before the purchase. You just added 10 more. Total units are 12,000. So the average cost of those 12,000 units, $5.60. So on August 14th, when you sell 8,000 units, how much do you debit cost of goods sold and credit inventory for? $560 each, or $44,800. After this sale, you're left with 4,000 units that have an average cost of $560. Notice the average cost doesn't change. Does not change. Total cost of the ending inventory after this sale, $22,400. When you go to the 18th, you go through the same procedures. You're going to buy 6,000 more. They cost $5 each, or $30,000 in total. So what do you have after this sale? You have inventory that costs a total of $52,400. $22,400 cost before the sale plus the $30,000 new total cost of this purchase. $52,400. Divided by the number of units you have now after this purchase. 4,000 plus 6,000. The new average cost per unit, $5.24 each. So on the 25th, when you sell 7,000 units, you'll remove them at $5.24 each, or $36,680. The 3,000 units you have left in inventory have an average cost of $5.24 each, $15,720. So that's how, actually in the perpetual method, you will do this perpetual inventory record simultaneously with your journal entries. Now, after you complete all your journal entries and post them to your T accounts, the ending inventory, the inventory account itself will have a balance of $15,720. Cost of goods sold T account will have a debit balance of $81,480. So we showed you the journal entries, and these last two exercises showed you how we determine the amount to debit to the cost of goods sold account and credit to the inventory account, or debit to the inventory account, depending if it's a periodic or perpetual, within those journal entries. Okay, final exercise 823. It's a specialty item called dollar value LIFO. Dollar value LIFO was adapted because if you notice with LIFO, really old inventory is left in our inventory account. And that's the whole purpose of LIFO. Last in, first out was created to expense the most inventory you possibly can and leave the lowest dollar amount in inventory. And that's why sometimes people can't grasp this. So write that down somewhere. LIFO, highest expense, highest amount in cost of goods sold, lowest amount in inventory. And we'll refer back to that. Remember what we're doing here. Because sometimes what happens with LIFO is that prices fluctuate, and normally prices increase over time. But sometimes some inventory items, the prices may decrease because of technological changes. Think of like your iPhones. You know, your iPhone 4 is a lot less money today than it was 2 or 3 years ago or whatever, okay? So because of technology, prices change, and that happens to our inventory as well. So sometimes, because of the way our inventory is selling and priced, it defeats the purpose of LIFO. We actually start selling off some of those really old items in inventory. And when that happens, we're selling them for a much higher price than that amount that was in inventory. And to try to circumvent that from happening and really helping companies to have the highest expense and the lowest inventory value, dollar value LIFO was created. And we'll show you what it does. So in this company, Baskins, they adopted dollar value LIFO for one of its inventory pools. The pools, and that's what, to do this method, you pool your inventory together, and that's something you would learn if your company uses it. For now, just know certain inventory items are put together and they're called an inventory pool. The pool's value on this date was $700,000. The year 1 and year 2 ending inventories valued at year-end costs were $750 and $820 respectively. The appropriate cost indexes are $1.03 and $1.05 for year 1 and year 2. So let's take a look. We have the various columns here. The first is ending inventory at base year, inventory layers at base year, inventory layers converted to acquisition year, ending inventory at dollar value LIFO. So we always have to pick a year that is our 100% year. And we always will refer back to that year. And that's 700,000. So at the lowest, our inventory will be 700,000. And that's where we want it, because that means we're expensing everything above it. So our ending inventory at dollar value LIFO costs 700,000. Watch what happens in year 2, or at the end of year 1, I should say, going end of year 1. What this is saying in our problem is that costs rose 3% over the year. 3%. So what we're going to do is take the ending inventory, 750,000, and pull out inflation. What would have been our inventory if there wasn't an increase in costs? Divide it by 1.03. Our inventory would have been $728,155. So our inventory really only increased $28,155. So if we bought this inventory back in year one, it would have been $728,155. So we're restating current prices back to year one of year one when we do that. So the first 700,000 stays at 700,000. The $28,155 is increase in the amount of inventory for that first year. So only that portion of the inventory should truly be at year one's prices. The first 700,000 is going to stay at 700,000, but that 28,155 will be restated back to current prices because that's the amount of inventory increase for this year. So how much is our dollar value LIFO inventory? 729,000. What does it say in our account right now? 750. Uh-oh. So we didn't expense enough of our inventory. So what dollar value LIFO says is, oh, no, your inventory balance, remember, we're focusing, trying to make it the lowest amount possible, should be 729, not 750. So what do you do with that difference of 21,000? You debit cost of goods sold and credit inventory. You didn't expense enough this year. So now we're truly living by LIFO. Expense as much as possible, keep inventory value at its lowest. And that's what we do. Watch what happens in year two. In year two, our ending inventory is 820,000. The cost index from 1/1 of 1 through the end of year two is 1.05. So prices have increased 5%. So if we bought this inventory at 1/1 of year one, it would have cost us $780,952. So now let's really figure out the dollar value LIFO. The first 700,000 is at base year. The next 28,155 is the same as last year. So that means our quantity, the price increased because of more in inventory, not because of rising prices, 52,797. So then we say, okay, the 52,797, we multiply that by this year's price index, 1.05%. Last year's 28,155, just like we computed last year, 1.03 is 29,000, and then the 700,000 is by 100%. So what's the dollar value LIFO? 784,437. According to our inventory account, it's 820,000. Yo, no, too much. So we decrease our inventory account so that it's at 784,437, and debit cost of goods sold increasing the expense, allowing us to truly have what LIFO is supposed to do. And sometimes it doesn't happen just because price technology changes and obsolete items and just the ways of the world cause us to have more in inventory than we should. So that is how LIFO, dollar value LIFO, works. So we had a lot of different things here. So if you go through these, you have questions, please post them on the discussion board or email me.